This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's go ahead and dive into our post-game chart book. Patrick, you put another great deck together. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage at macrovoices.com. Click the red button that says Looking for the Downloads. Patrick, page 2, S&P Futures. Boy, the last time we got a correction that panicked everybody and made them say, oh my God, the sky is falling, the bear market is resuming. It only lasted a few days and it was over. Now, is this one over?
That's a really great question. I titled this week's entire chart book as Was It Enough? And really what's interesting is I typically don't put moving averages and things like that on the charts, but I think the 50-day moving average is particularly interesting when you're going right across the entire spectrum of stocks and markets. And I wanted to really reflect on that. So what we typically have seen in the past is market corrections will, do 50% retracements of prior rises. They'll come down to the moving averages, and the buy on dip traders systematically buy the dip. And it usually lasts, these 3 to 5 days, and the traders come back in and start their accumulation. And so we got exactly that in a textbook fashion. And really, this is actually an incredibly important moment. The way I would describe it is it's like the market walked to the edge of the cliff and looked over the side, but didn't lose its footing. And this is a really important next few trading sessions, because the bulls would typically, and did in first reaction, put together the rebound, this up day. We saw 80 S&P points rebounding off the low. The question now, is that enough to trigger the buyers, a feedback loop where the buyers now buy the dip and accumulate it? And it's so important to find that out, because the gamma flip zone and all of these technical sell signals are all just right below the zone. And I know you were suggesting that support line around the 32.25 area where those highs came in June. But in my mind, if the bulls don't hold the line here, there's an air pocket sitting right underneath. And I'm not trying to say it has to be the next bear market crash, or even though I think that there's a reasonable chance it could happen, I do think that the market correction will quickly tack on 200 to 300 S&P points lower if this support line doesn't hold. And so watching what the market does here in the next 24 to 48 hours is going to be really important.
Let's move on to chart 3, which is Tesla. Now, our good friend Jim Bianco at Bianco Research has written quite a bit about Tesla, observing that probably what's been driving this fierce upside speculation was a lot of belief on speculators' part that Tesla would be added to the S&P 500 stock index. And it was the event of that not happening, the fact that Tesla was passed over and not included in the index, that appears to have marked the top here. Are we seeing a meaningful bounce? Is the reaction to the S&P non-inclusion over and the rally set to continue? Or is this just a little dead cat bounce off a technical level before the bottom falls out?
Eric, it's noteworthy to also point out that Elon Musk did that capital raise right at the near the market tops, taking advantage of those very high prices. The observation that I wanted to make on Tesla is twofold. Well, first of all, it bounced off the 50-day. It seems to be a reoccurring theme in so many of these charts that the corrections mean revert back to its 50-day averages, which technically is common. And we see that Tesla made that drop. But what I'm curious about, and if you notice those 3 red arrows, I marked the key tops that happened on Tesla during each prior advance. And what's particularly interesting is after one of those highs are put in, there's often some form of a retest of those highs. And I'm really curious whether Tesla will be able to muster up a rebound back towards its highs to mark some sort of a short to intermediate top. But there's also a lot of technicians out there talking about this kind of 400 to 425 area. And it'll be, if all the bulls muster up on Tesla is just a small rebound up to those levels, it may very well be that not only a top is in, but a much deeper, more meaningful market correction may be underway. And so I think that's really interesting. And using that as a theme to go to chart page 4, the chart of Apple. Again, Apple corrected. It was about a 50% retracement down to its 50-day moving average, a very typical place where one would anticipate a buy on dip to happen. And so we're seeing all of these markets all coming to the same edge of the cliff moment. And initially, the buy-on-dip traders did show up, and they did rebound it off their lows. And now the big question in the next few days, will they be able to make any rally stick? Because if the bears sense that there's no more buying pressure to take it higher, they'll start hammering it pretty hard. And I think that that's going to be the big theme. And by the time we're on the next MacroVoices episode next week, we're going to have a lot revealed in terms of what these trends are that have emerged, right?
Now, I think it's really interesting to look at page 5 because what a stark contrast between the shape of the S&P 500, really just accelerating into what might have been a blow-off top, or maybe it was just a little correction. But we've seen really since June, nothing but trading sideways on the EUROSTOXX 50 index. What's going on there?
Well, if I told you that this was the crude oil chart, would you have believed me?
It looks like it, except it doesn't have the down move that we just went
exactly.
through.
And it's interesting, but it really goes to show that the vast majority of the equity price action was very much focused on the American market, and a lot of these other major developed markets have really been just dead money. I mean, if you look at the charts on the Aussie 200 or on the London FTSE, very weak charts. This certainly has not been a very broad global equity rally. This has been very U.S. centric. And what will be interesting is we're hovering right along that 50-day, no different than that crude oil chart. It'll be interesting if the market was to break, whether the EUROSTOXX will break with it, and whether this was just a topping formation in at least a bear market in the EUROSTOXX. And that's something that I'm going to be watching definitely in the next week.
Let's move on to gold futures on page 6. It seems like that moving average line that you've got drawn in red, we're pretty much always holding above it. But then again, the excursion in March was at least a short-term move below it. Are we going to see another one of those in gold here, or are we going to just head higher from here?
Well, again, I think that the whole theme of the chart book was to see how all these different securities are all lined up with this 50-day moving average. And this is why I was describing at the beginning is everything seems to be at the edge of a cliff, hasn't gone over, but did take a peek over the side. And we're going to find out here in the next week whether or not these key support lines give out. You were pointing out in the market wrap at the beginning that triangle formation that seems to be forming as into this coiling wedge. And usually these wedges resolve with some sort of an explosive move. And we can speculate on which direction that is. But, I mean, if the whole market starts to sell here, we've seen in the past that gold does succumb to some of the correlation to the markets and does at least initially sell if it is a bit of a broader liquidity event. I know I've heard a number of people speculate that they think that gold will decouple this time around and not participate in a correction, but the jury is still out. I'm curious which way this will break. So far, gold has done a pretty good job holding that 50-day moving average.
Well, Patrick, I really have to disagree with some of the views that you hear out there, and I've heard them too. It doesn't matter how strong the fundamentals are to the upside for gold. If people are panicking and markets are crashing and there's a rush to liquidity, people end up panicking and selling everything, whether it makes logical sense or not, and whether it jibes with fundamental arguments or not. It just stuff gets sold off. I'd love to see that happen to gold. It would be a great buying opportunity to pick up some more.
Right. So what I want to do is move on to chart 7. And particularly, I wanted to focus on that Euro USD. I know you were talking about the Dixie and the fact that the dollar index really needed to break above 94 to really kind of advertise a bottom as being in. But what I'm particularly watching today is the fact that we had the ECB come out with their press conference and their monetary policy. And the first reaction was the euro went higher. But what I have through my years of trading noticed is that usually the first reaction to a central bank announcement tends to be faded the other way. And what will be interesting to see is that if this attempt to rally the euro fades and we find ourselves trading back below 118 and heading lower, that could really be the first sign that US dollar bottom is in place, especially considering the weighting that the euro has inside the dollar index. But we saw a pretty big breakdown in the pound sterling and all sorts of other things starting to happen. Maybe the short-term bottom may be in on the dollar, and this is something that I'm looking for the cue from the euro in the next few trading sessions. Anyway, Eric, though, I wanted to move on to crude oil because I know you did a great job describing it in the market wrap, but I really wanted to just show how that consolidation just broke to that downside. And now I particularly show now the October contract because whenever we show the continuous contract, it shows that minus 40 print, which just mutates the chart. But when you're looking here, I mean, we put some pretty meaningful bottoms in oil back in March and April. And clearly, oil has or is at least advertising that it's going for some form of a retest to establish a longer-term bottom. But do you feel that generally that the major lows of oil are in and that this is just a retest of some form along the bottom end?
Well, I think what's probably going on here is a change of analysts' fundamental sentiment. Now, I certainly agree the bottom is in at minus $37 or whatever we saw in the May contract. We're not going to minus $47, on the October contract. That's not going to happen. But let's just talk about why is it that we saw such a brisk rally off of the April lows. And then the consolidation that we've seen ever since the middle of June or the beginning of June has been a steady drift higher, even when you would have expected some kind of natural retracement. Well, I think what was going on there is most analysts are looking at this saying, look, they see the same thing that Art Berman told MacroVoices listeners back in early June when we had him on the program, which is, look, guys, there's plenty of room for this market to go down over the summer, but eventually in Q4, we're going to see U.S. production fall off a cliff because the rig count just has not recovered. They're not making new ones anymore. We got to go through the inventory of drilled but uncompleted wells. Maybe there's room for downside in the summer, but you get to Q4 and you're going to see U.S. production falling off a cliff. I think the fact that everyone knew that Q4 was eventually going to bring us a sharp decline in U.S. production is what was holding the market up and allowing it to just very slowly edge higher all throughout the summer in anticipation of a move up as U.S. production declined. Then what actually happened is, oh my gosh, these refinery runs are telling us that, yeah, we may still expect U.S. production to decline. But first of all, it hasn't declined that much yet. And what has declined a lot is demand as measured by refinery runs. So people are saying, oh my gosh, this is going to be a demand story, not a supply story. And it's an ugly one. Now, how bearish is that? How much farther do we have to go? I don't think it's minus 37 again. Is it back down to 30 or low 30s? I won't be at all surprised by that. In fact, that's my base case is somewhere between $30 and $34 is where this market bottoms. What would it take to get it to 26? Just a little bit worse demand picture and maybe a little bit of laziness in the data so that we don't see that decline in U.S. production as soon as people thought. We could easily get back down to 26. 26 is a pretty significant support level. To get markedly below that, I think you'd really have to have some significant news or change in outlook. But whether we're done here, having tested 36 or we get to 26 or something in between, I'm not really sure. Lower than 26, I think it would take something pretty big to make that happen. But Patrick, I want to come back to lumber futures, which we talked about last week or the week before on page 9. Now, when you and I saw this just runaway rally to the upside, we both thought, okay, what must be going on is because of the pandemic, there is a rush into high-end construction. People want to build that house in the countryside to move out of the city, and probably with the logistics of the crisis, it's really putting a huge demand on lumber. All of the sudden, everything turned around and went into reverse, and we've seen several limit down days where the market was just locked at a limit down condition, 1, 2, 3, and we're way back down here. I've got to be honest, Patrick, I have no clue what brought this about. Do you have any insight on what might be the fundamental driver?
Well, I don't know about the fundamental driver, but it certainly was that lumber went parabolic. We joked about the fact that this was the Tesla chart, and it's really been going parabolic during the same time as the Apple and Tesla moves were happening. And it was just, I think, just this risk-on impulse in lumber through the home builders and everything. That's just a place where all the money was flowing. What's amazing is I don't think there is any correlation to it, but a coincidence. But lumber literally put in its top the same day that Tesla did, and it really we've seen the same type of pullback. And what's amazing is we don't too often get the opportunity to see these limit down days where, like there were in the good old days of futures trading, where literally you'd go lock limit down day after day, giving no window for traders to be able to get out. And to see this happening in the lumber futures this many days in a row is certainly a little bit for the history books, but nonetheless, definitely a mean reversion. We lost like 25% on lumber prices in a span of just 5-6 days, and so it's certainly something that I'm going to be watching here in the days to come. As to a fundamental reason, I think everything was just so overbought that I think that it's just so natural from a reflexivity perspective for things to just take a break and backfill and some profit taking to be done, right?
Listeners, if you want to look over Patrick's shoulder while he watches this and other markets in coming days, be sure to get a free 2-week trial of Patrick's service, Big Picture Trading.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.